Değerli misafirlerimiz, şimdi zirve açış konuşmasına geçiyoruz ve bu noktada Profesör Doktor Sayın Obiyathulla İsmath Bacha hocamızı huzurlarınıza davet edeceğim. Buyursunlar lütfen.
Assalamu alaikum wa rahmatullahi wa barakatuh. And a very good morning, ladies and gentlemen. Let me get started. Can we please have the slide? First of all, let me thank the organizers for giving us meaning INSEF, an opportunity to share some thoughts with you. Okay? The title of my presentation is, For Greater Economic and Social Impact, Islamic Finance Must Address Its Gaps and Missing Links. Basically, what I argue is that, yes, Islamic finance has done very well in the 40 years that it's been around, but there are certain shortcomings that have to be addressed if it is to go into the next stage. Yeah? And that's what I want to share with you, some of those thoughts. So, effectively, I'll be talking about 4 things. Infantile capital markets, that's one shortcoming. Sukuk, very short-term in orientation and debt-based, and why that is a problem. We'll talk about the lack of money markets and how liquidity management is a huge problem in Islamic finance and in all the related areas. And finally, the near total absence of risk management tools. And this is a soft underbelly of Islamic finance. The soft part, basically, it's a huge weakness. And I'll show you some numbers about how it's holding back, especially the equity markets, Islamic equity markets. So let me move on. If you look at growth, and this is Islamic banking and finance together as a sector, what you notice is, yes, it's grown very well. Sorry. It has grown very well. It's gone up year after year. Quite impressive. And it looks like it's going to hit 5-point-something trillion in 2027. Good. But there are some problems in there that these numbers do not really show. And that is what? The first one, as I mentioned, infantile capital markets, banking sector dominance. So if you look at the proportion, the breakdown, what you find is 70% of the sector of entire Islamic banking and finance is made up by Islamic banking. Sukuk is about 20-something%. Takaful is a mere 1% or so. And Islamic fund management, equity management, which is so vital in capital markets, is only about 3-something, 4%. Okay. What is wrong with this bank-dominated financial sector? There's a big problem. You see, if you think of the economy, macroeconomy, economies divide the macroeconomy into 2 parts, the real sector and the financial sector. The real sector is where goods and services are produced. The financial sector is there to fund the real sector in its activities. That's the job of the financial sector. Whether the financial sector is heavily bank-dominated or capital market-dominated matters a lot for overall macroeconomic vulnerability. Because the banking system, remember, only gives out one kind of financing, debt. And it's risk transfer. So basically, the system itself builds up a lot of vulnerability when you have a financial system that's very heavily bank-reliant. For example, the 1997-98 financial crisis in Asia opened the eyes to many policymakers in Asia, in Malaysia, in Indonesia, in Korea, Thailand, etc., that you need to move away from a bank-dominant or bank-reliant financial sector into something that is more capital market orientation. And the reason is because, as you'll see in the next slide, okay, oh, by the way, this is simply showing you that even though the banking sector is so dominant, guess what? Most of the financing, 70% of the financing, is all debt-based contracts. This is for Malaysia, but it's quite true for the other countries too. But what is the problem with that? Okay, the problem is this. First of all, banking system in any country, there's only so many banks. It's oligopolistic. And because of that, the risk gets concentrated within those few banks. And all it takes is a single bad bank to endanger the entire system. See that? And that is why governments have to come in and bail out, and you have all these moral hazard issues, problems, etc. That is opposed to banking system, capital markets. Imagine this, if a company wanted to borrow money from a bank, they borrow money from a single bank, and they invest in a project. If that project goes bad, the bank gets hit, and if it's a big bad loan, then the entire banking system becomes very fragile, gets into trouble. But if instead of bank borrowing, if the company had issued capital market instruments, for example, bonds, or better still, stocks, equity, then what happens is you have thousands of investors who have invested in the bonds, you have thousands of equity holders, and so the risk automatically gets dissipated. So the point is, with banking system, risk gets concentrated and it endangers the overall economy. But when you do it through capital market instruments, the risk gets dissipated, spread out. And so as a result, the economy, overall economy, becomes a lot more stable. And this is, lessons that have come out from crisis after crisis. And, every single crisis has been caused by excessive debt. So you need to move away from those things, and banking system, bank reliance won't help us with that. Finally, also, keep in mind, the contingent liability of governments becomes a lot less with capital markets as capital markets become more important. Because with capital markets, you don't have to go in and bail out equity investors. You don't have to bail out bond investors. But you must bail out banks. Otherwise, they endanger the whole system. So the contingent liability on governments is a lot less when you have capital market reliant systems. Next. The second problem when it comes to sukuk in the Islamic finance space. You see, sukuk are a wonderful instrument. A lot of times it gets compared to Islamic bonds. And they even call it Islamic bonds, which is, it doesn't do justice to what a sukuk is. Because a sukuk, depending on its underlying Sharia contract, can be a very, very different animal from a bond. You see that? And if you take those 14 accepted Sharia-compliant contracts, Murabaha, Mudaraba, Musharaka, etc., those 14 contracts, and if you arrange them, what you find is, at one end, on a spectrum from debt to equity, certain contracts like Murabaha, like Ijara. Murabaha is pure debt. Ijara is very close to debt, and so on. And then at the other end, you have contracts like Mudaraba, Musharaka, which are more and more like equity. Remember, equity is always safer. Debt is dangerous, risky. And like I said earlier, every single financial crisis has been because of debt. There's never been a crisis in history because there was too much equity. No, that cannot happen. It's a lot more safer. Now the point is, if you had a mudaraba, perpetual mudaraba sukuk, then it's pure equity. Because the real difference between mudaraba and equity is mudaraba has tenor, equity has no tenor. That's the only difference. Otherwise, it's residual, it has all the flexibility, etc., etc. Unfortunately, while the space for sukuk contracts can be very rich, unfortunately, if you look at the number or the percentage of sukuk that are based on murabaha or debt-based contracts, versus equity or quasi-equity contracts, this is what you're seeing. The majority, okay, the majority of contracts, more than 70%, etc., of all contracts outstanding, all sukuk-based contracts outstanding are on debt-based contracts. And to me, it does injustice to what you can do with sukuk. Because you can structure sukuk to be more and more quasi-equity-like, a lot more safer. But why this reliance on debt-based contracts? Can we go to the next slide? So this is to show you from 2001 to 2014. In that period, notice the reliance on debt contracts. Has there been evolution after that? Well, the next slide, please. You see the same dominance of debt-based contracts. So nothing has changed. And why hasn't it changed? Well, basically because bankers and regulators, they are all very adapted to debt-based instruments. And the argument often given is that if you issued a sukuk based on mudaraba musharaka, the acceptance, market acceptance will be low because it's difficult to value, if it's difficult to rate, and all those things. Yes, it is difficult to rate because it's not a debt. You see, but so much of the system is geared towards that these other instruments are not being well received. Can we go to the next slide? So, not only are sukuk mostly based on debt contracts, but look at the maturity. This is the maturity of outstanding sukuk, okay, globally. A big chunk of the sukuk outstanding, close to 60 plus percent, close to 70%, are less than 10 years. Okay, less than 10 years. Now, why is that a problem? What does it mean? It means that a lot of the sukuk are not being used to fund greenfield projects, not for infrastructure, not for development infrastructure, definitely. Because if you want to fund development infrastructure, you need 15, 20, 30 years sukuk. But that's not what's happening. So a lot of it is happening is basically short-term debt, working capital kind of financing that is happening, okay, using sukuk. Next slide, please. These are three, just to show you how sukuk is basically being compared with debt. It's being treated like debt. It's being traded like debt. These are three countries. The one right on top, the first one is Turkey. It's a little dated in terms of time, but please bear with me. The first is Turkey, then Malaysia, and Indonesia. The line in green is the yield on local currency bonds, local currency. So for Turkey, it's a lira. For Malaysia, it's the ringgit-denominated bonds. And for Indonesia, rupiah denominated. What you see is the green line is so much higher than the red and blue. What is the red and blue? The blue is international US dollar denominated bonds, the blue lines. And sukuk is shown in red, okay? Now, first thing to notice the big difference in yield, the gap, the spread between the green and the blue. And what that tells you is that's the currency risk premium, okay? That is coming purely from currency risk premium. Now, for Turkey, it's much larger. The scale is not the same, yeah? So please bear with me, because on the scale is not the same. I had just squeezed all of those diagrams into the same thing. It looks like as if it's the same. It's not. For lira, it's higher. For Malaysian ringgit, it's much, much lower. And for Indonesian rupiah, something in between. So that's one point. And that's not surprising that home currency denominated bonds would command a higher yield. The next two lines, the red and the blue, they are both US dollar denominated, so there is no currency difference now. Both same issuer, But the blue is bonds, sovereign bonds. The red is sovereign sukuk. Okay? And what do you notice? Well, notice the strong correlation in the yields. What that tells you is the bond is being, the sukuk is being traded exactly like it's a bond. There's no difference. Also interesting, the yield on the sukuk is always slightly higher than that of this thing. And that, we feel, it's basically due to liquidity risk premium. The sukuk is slightly less liquid, and therefore nothing. But the point of this is to show you that the market treats sukuk like bonds, like any other debt instrument. And that is a pity, okay? Because it could be very much more different. And government after government has issued ijara-based sukuk, which is, again, debt instrument. And every time you issue a debt-based sukuk or bond, what you do is you increase leverage. Your debt to GDP goes higher, your macroeconomic vulnerability increases, and all the bad things that happen with debt happens here. Next, please. So the third big shortcoming, if you will, in the Islamic finance space is the lack of money markets. The only country that has a full-blown Islamic interbank money market is Malaysia. In all other countries, you don't have an Islamic interbank money market. And yet you have Islamic banks. So how do these Islamic banks manage their liquidity? The answer is, in most cases, through bilateral arrangements with the central bank. So, for example, if you take Bahrain, every time, or even Indonesia, every time an Islamic bank is short of funds, they sell sukuk to the central bank, and they get the funds. Every time they have surplus funds, they buy sukuk from the central bank. You see that? So they manage the liquidity that way. So it solves the liquidity problem, yes. But it doesn't do something very important, and that is, it doesn't allow for price discovery. Because unless you have trading, how do you find price discovery? Remember, even the Rasul, he had said, if you remember that famous hadith about the two Sahaba who came to him, and they said they had two different quality of dates, and they couldn't agree on the exchange rate, meaning the price of each. And they came to the Rasul and said, you arbitrate, you tell us how many kilo of this for how many kilo of that date. And the Rasul said, that's not the way to do it. If you want to know the correct way, the fair way, each of you bring your dates to the market, try and sell. See what price you can get, and use that price to determine the rate of exchange. What does it tell you? I mean, the importance of price discovery. It's so very important. Yet, because we do not have Islamic interbank money markets, banks, Islamic banks, they really cannot tell what their real price is, their real cost of funds is. And I'll show you what the problem with that is. Next slide, please. By the way, so you notice Turkey, for example, your government has issued a sukuk, sovereign sukuk. Malaysia has issued sukuk, sovereign sukuk. Again, even Saudi Arabia. These are ijara-based sukuk. And the sukuk, the ijara payments are determined by what? By LIBOR. What is LIBOR? London Interbank Offer Rate. It's an interest rate. So this is the irony. When I teach Islamic finance, in the first class we tell the students how bad interest rate is, how exploitative it is, how it should be banned, etc., etc. And then they go to fourth year and they do sukuk structuring, and we say the best way is to use LIBOR. Ironical. Doesn't make sense, right? But why does that happen? Because what is the alternative? Why isn't there an Islamic alternative to LIBOR? Because there's no trading. How else would you discover? So yes, you don't want to trade murabaha sukuk. But you can trade musharaka sukuk, you can trade Mudaraba Sukuk, you can trade Wakala Sukuk, you can trade many other risk-sharing kind of Sukuk and still have some pricing. But these are problems that we need to address. Okay, hold on. So IBF, as a result, will always have to depend on interest rates for its activities because you got no choice. And Islamic banking and finance will always be less profitable and more costly because you saw that premium, right? And the cost of capital to Sharia compliance will always be higher and it's so disadvantaged. Next slide, please. And this is to show you what I mean. This is from the Gulf states, something called Islamic Interbank Benchmark Rate. Yeah? Basically trying to determine what the benchmark rate. What they do is Thomson Reuters, they get a number of Islamic banks in the GCC countries. They get them to quote their rate, and then they take an arithmetic average. Okay? And basically they then say, okay, that's the Islamic interbank benchmark rate, which banks use for pricing and all those things. But the problem is, you know, if you ask yourself, where do these banks which give the quotes, where do they get the rates from? The answer is, they basically just look at the conventional interest rates. And here's my evidence. So if you look at, you know, the one on top, Islamic interbank rate overnight versus LIBOR overnight. So you see at the bottom, LIBOR in green and the blue Islamic interbank rate. And then Islamic interbank 1 month rate and LIBOR and so on, all of them. Now what you'd notice is the correlation is 90%, 95, 99%, very strong correlation, meaning they follow together. But more importantly, every one of those Islamic rates is higher, meaning the cost of funds are higher. You see that? So basically because we have no choice but just mimic what's happening. And these are problems we need to address. Let me go to the last issue. Next one. The final big shortcoming is the near absence of risk management tools. Because risk management is so very important in finance. And there's a whole area of financial derivatives, okay, futures, option swaps, etc., that is used for managing risk. But when it comes to the Islamic finance space, there is really very little. And even after 40 years, there's a dearth of Sharia-compliant risk management tools. We have come out in Malaysia and in other countries with something called the Islamic profit rate swap for Islamic banks to manage their profit rate risk, interest rate risk, basically interest rate risk. What is the Islamic profit rate swap? It's nothing but the interest rate swap done by buying and selling, underlying asset. Why do you need that? Well, because the Islamic banks are pretty much, like I said just now, so heavily involved in debt-based financing. So they have the same interest rate exposures, the same duration gaps, etc. They need to manage it. And then lately, we have also come out with wa'ad-based. Wa'ad are basically promises. Wa'ad-based contracts for foreign currency risk arrangements, okay, hedging currency risk, which is a clever thing, wa'ad-based instruments. But if you think about equity, how do you hedge if you're an Islamic mutual fund, if you're an Islamic unit trust, if you're a fund manager, how do you manage risk in a Sharia-compliant way? The answer is there is no way you can do it, because the instruments just don't exist. And this is holding back a lot of the equity-related instruments and the equity, Sharia-compliant equity industry. Next slide, please. Okay, so basically, if you see, and I think one of the earlier speakers also touched on this, that asset under management for Islamic funds had shown a decline. Okay, decline, coming down, even though, you know, globally indexes are all at record highs, etc. But it's been showing a decline. But the next slide, please. Here, this shows you If you think about global asset under management for all equity funds, together is USD 118 trillion. 118 trillion. What is the size of Islamic funds under management? 182 billion. If you think about it, and these are the latest numbers, if you think about it, how much is that? 0.15%. 15 basis points. That's how small the Islamic equity space is. Okay? I'll talk a little bit more about this. Very, very minute. Let's move on. Next slide, please. Not only is it very tiny, if you think of in terms of asset size, how big are these funds? Very small. The majority of them are below 5 million US dollars or 5 to 25 million US dollars, etc., meaning very tiny. Okay? And if you think of composition, where do the Islamic funds put their money in? Interestingly, not as much in equity as you would expect. The typical fund, for example, mutual funds, the conventional ones, they have 70, 80% in equities and then small portions in other things. But here, notice, it's only about 30-something% that is in equities. A lot of it is in commodities, etc. Hold on, go back. A lot of it is in commodities. How come commodities? Because it's easier to hedge. You see, in a Sharia-compliant way, it's a lot easier to hedge with commodities. So that is the situation. Let me move on. So, why has this been the case? Because so far we have basically done a lot of imitation, not innovation. 40 years, just imitated the products, the processes, and even the regulation. And so the end result is you have these big problems and a huge paradox. And what do I mean by this paradox? Next slide, please. This is a listing of the top 20 sovereign wealth funds of the world. The world's largest 20 sovereign wealth funds. The ones in red are the ones from Muslim nations. Turkey, you have Turkey Wealth Fund in number 13 and so on. If you counted, there are 12 of the top 20 funds, meaning 60%. And the total asset size is 5 trillion over. 5 trillion over US dollars from the Muslim world. What does that tell you? It tells you the Muslim world doesn't lack resources. There is money. There is plenty of money. But here's the paradox. Next slide, please. Take a look. Where are these Muslim sovereign wealth funds? 60% of the world's top 20 are from Muslim world. Where are they placing their money? Definitely not in the Muslim world. How do you know? Well, look at this. The largest by market capitalization is Saudi now. And that Saudi used to be much smaller. But after Aramco, thank you. After Aramco came in, they have gotten to be big. But even then, if you look at it, it's about 2.7 trillion. Tehran next, 1.5, and so on. These are the top 10. But compare it with a single company, Apple. One company, Apple, 3.38 billion. 3.38, 3,300 billion. That, in other words, a single company has market capitalization much larger than the entire Muslim world's top market. And similarly, for Microsoft, NVIDIA, Amazon, much larger than any of this. So how do you explain this paradox? That there is so much of wealth. So where is all this wealth going into? Must be into Western equity markets, Western capital markets. So these are big concerns that we need to address if going forward. My final slide, please. Last slide. Okay, so basically concluding remarks. Despite 40 years of what appears to be there is a disconnect between what the Muslim world needs and what IBF has offered thus far. The Muslim world needs less macroeconomic vulnerability and exposure to external shocks. But IBF is heavily bank dependent and debt dominated, which means they cannot provide you that kind of safety. Second, the Muslim world needs sustainable financing to fund long-term development infrastructure. But sukuk are mostly short-term and also debt-based. In other words, these instruments that we have in Islamic banking and finance today are not addressing the real needs of the Muslim world. And then the Muslim world needs to detach from interest rates and have its own price discovery mechanism, but again, the current IF space does not allow for that. Finally, you need better risk management processes and more efficient capital markets, but the reality is markets are still very infantile. There's a lot of things that we need to do. Thank you very much.
Efendim, zirve açılış konuşması için Profesör Doktor Obiyathulla İsmath Bacha beyefendi hocamıza çok teşekkür ediyoruz.